Look, we have to stop trying to time the real estate market. In Southern California, especially San Diego, the real edge over the next few years will come from understanding the market and staying invested, not trying to pick the perfect day to buy or sell. Timing the market sounds easy in hindsight, right? I should have bought in 2019 and sold in 2024. In reality, real estate cycles move slowly, data lags, and by the time the headlines confirm a shift, smart money has already moved. Everybody wants to buy low and sell high. It just makes sense. But real estate just doesn't work like a stock chart you can day trade. Interest rates, inventory, jobs, migration, even local policies, they all interact in this messy, unpredictable way. So even economists and seasoned investors rarely nail that exact top or bottom. What actually wins over time is buying good properties that have true cash flow, letting that long term appreciation and disciplined management do the heavy lifting, and using tools like 1031 exchanges to reposition without losing ground to taxes. So let's take a look at what happened in San Diego in 2025. The market was the strongest in the spring, roughly March through May. Then it cooled and settled the rest of the year. We saw a little bump in activity in the fall when mortgage rates dipped into that low six range. Then things slowed again as rates edged up a little bit, and that long government shutdown pretty much hammered all consumer confidence. That slowdown feels uncomfortable, but historically, those softer periods often set the stage for that next rebound as pent up demand builds. So, why am I so bullish on spring 2026? Going into spring, several pieces are lining up for a healthier spring market. Number one, the Fed officially ended its quantitative tightening program on December 1st after shrinking its balance sheets since mid 2022. Those were one of the drivers of elevated rates. With quantitative tightening done, many analysts expect less upward pressure on long term yields, which should help those mortgage rates gradually drift a little bit lower. Most forecasts suggest that the 30-year mortgage rate could move solidly into that low six and potentially even flirt with that high five number over the next 6 to 12 months if inflation cooperates. But even a small rate drop can meaningfully improve affordability and move more buyers back into the game. And that's exactly what's going to fuel this spring rebound. Looking out 2 to 4 years, I predict a more normal market is likely. We're going to see appreciation tracking closer to inflation, wages slowly catching up, and fewer of those wild double digit jumps that we've seen over the past 5 years. For long term investors, that kind of stable, boring growth is often where that real wealth quietly compounds. So instead of waiting for that mythical perfect moment, focus on buying quality, managing well, and using strategy, not headlines, to drive your decisions. If you have any questions about the Southern California market, 1031 exchanges, or want a second opinion on your investment property plans for 2026, reach out. This holiday season is the perfect time to reset, plan, and get ready for that spring rebound. My name is Ryan Prazen. I'm the Director of Real Estate Sales and Investments for Good Life Property Management. Look forward to hearing from you.